Hi guys, welcome back to another video. My name is Josh and welcome to the quarantine edition of this channel. As you can see, my facial hair is not shaved off and my hair is a bit long, and that's because I just haven't been out. I've been working all day and all night for this video because in my previous video, I did mention that if I got 120 likes on that video, I'll make an in-depth analysis of Auckland International Airport. Funnily enough, you guys actually did like the video and it had more than 120 likes. So I am making this video today just for all of you guys. Be sure to leave a like, subscribe, and follow me on Instagram as well. Now, before we continue, I want to make sure that you guys know that I'm not an authorized financial advisor. What I say in this video is not financial advice. I'm not recommending you to buy or sell Auckland International Airport. If you need specific financial advice, do seek help from an authorized financial advisor. Now, without further ado, let's go right into the video. Auckland International Airport was opened in 1966, and in 1998 it became fully privatized after the New Zealand government sold its remaining shareholdings. Auckland Council still owns roughly 22% of the airport, and Auckland Airport is essentially New Zealand's largest airport, handling over 21 million passenger movements in the year to 30 June 2019. AIA is one of New Zealand's largest listed companies and is included in the NZX Top 10. So chances are, if you've invested into an ETF in New Zealand or you have KiwiSaver, then you'll indirectly own Auckland Airport shares. Now, these shares were trading at a close of $5.75 per share, and in the past 5 years they've gained about 25.8%. However, year-to-date performance has been quite terrible due to the current situation. The share price has dropped $3.43 or 37.36%. Okay, so now you might be wondering whether it is a good time to buy the stock, and that's what we'll have a look today at the business and what actions that I'm taking as well. So to be honest, I actually did sell all of my Auckland Airport shares in my private portfolio, and I'll explain later why. To see whether it's a good buy, we have to look at the airport industry in New Zealand. There are 5 international airports in New Zealand. That is Auckland, Wellington, Christchurch, Queenstown, and Dunedin. Now, Auckland, Wellington, and Christchurch are the major travel hubs, and over 70% of total international passengers coming into New Zealand go through Auckland International Airport. And AIA accounts for roughly 39% of total industry revenue. Okay, so they are quite a big player in this industry. And more recent economic and travel boom has led to high growth in the industry, meaning that major airports are nearing capacity. And what this means is that a lot of these airports need to spend money on capital expenditure to build up their capacity. And we'll take a look at that later for Auckland Airport. But let's first look at the revenue stream. So AIA has well-diversified revenue streams, and they have 6 revenue streams, being aeronautical, retail, transport, property, hotels, and revenue from their 25% ownership in Queenstown Airport. I want to highlight here that aeronautical is actually a regulated form of revenue. In more recent years, the Commerce Act was amended, which clarified the process the Commerce Commission and the government can use to intervene should they consider Auckland Airport's charges are not justified. And on 22nd February 2019, Auckland Airport did announce a reduction in its target return from 6.9% to 6.6%, which represented a 33 million reduction over the 5-year pricing period in net present value terms. They are a natural monopoly, and so, the Commerce Commission usually regulates these monopolies so that they make sure that they're not overcharging their customers. And here is the summary of their regulated profit. They have, air landing facilities, air parking facilities, passenger terminal facilities, check-in facilities, and other regulated activities. So you can find this on the investors page on the Auckland Airport website. And regulated profit made 46% of total profit in financial year 19. And if you see here, the average charges per person in FY19 coming in from international was $23.07. So that has decreased over the years due to the changes in the regulation. And domestic charges has stayed relatively flat at $6.06. Now, just because it's regulated doesn't mean that they haven't been growing in the past few years, because if we look at the past 6 years, they've actually grown quite significantly. So the 5-year compounded annual growth rate for revenue and EBITDA or EBITDA was 9.3%, and reported an underlying profit has grown by 10%, which coincides with the recent economic and travel boom. Taking a closer look, in their most recent half-year result ending 31st December 2019, their revenue growth of 1.1% and underlying profit growth of 2.2% wasn't as high as the past 5 to 6 years. And this was a reflection of reductions in airline seat capacity, as airlines consolidated their networks, as well as total passenger numbers falling 0.5% in the past half year. And their CEO also mentioned that global tourism has experienced rapid expansion in the past few years, and it's clear that the market has cycled into a consolidation phase, and this is naturally reflected in our interim results. Essentially, what he means is that the market is slowing down even before the whole situation began. How do we know whether Auckland Airport can survive this? Well, thankfully, they do have a very resilient long-term passenger growth. It's worth pointing out that despite all the near-term impacts of the current situation, AIA has been able to weather the storm in previous economic recessions and external shocks. And as you can see in this picture, the only noticeable drop in the past 20 years has been the GFC in 2009. Over the past 20 years, passenger growth has grown at a compounded annual growth rate of 5.2%. And more recently, in the past 5 years, passenger growth has actually outperformed the past 20 years. And that also is one of the reasons why they need to spend so much on capital expenditure, because of the recent increases in passengers coming in. And to give you some context, operating cash flow in the first half of 2020 was $169 million. And if we look here, that they actually spent in the first half of the year $230 million. Okay, so what that means is that they have spent over and well above their operating cash flow, meaning that they have to borrow to service the shortfall. I took a look at the cash flow statement and I saw that net debt has actually increased by $190 million in the most recent half-year results. Okay, so they are using debt to fund their capital expenditure. And you can see here that they expected to spend about $450 to $550 million in capex. It's actually dropped slightly because of the current situation, but that just gives you some context in terms of how much capital expenditure that AIA was planning to spend on. Okay, so this is a very highly capital intensive business. Now, looking at their funding position, they have a significant amount of debt due in the next year, about $400 million there. They also have a very stretched dividend policy, paying out 100% of underlying net profit after tax. They're paying out 100% of their profit. They're not reinvesting that. They're borrowing instead to invest into new capex. And their gearing ratio is at 28%. I don't really like the metric that they use here of using debt plus market value of equity, because market value of equity can move time to time. As you can see now in the volatile market, that metric won't be as appropriate. So using the book value of equity, their gearing ratio is currently at 28%. So it's not significantly high like, other companies like Air New Zealand, but it's still not low either. And because we know that they're paying out dividends, they're borrowing money, they actually rely so much on their current operating cash flows. So what happens when operating cash flows stop coming in, which is what's happening with the current situation? then you have problems, right? Because you need to then find money to come in on top of the debt that you're already borrowing. And so the only reasonable way that you can get new money is from going to your investors to ask them for more money. Which leads me to my next slide. In more recent news, AIA to raise $1.2 billion to strengthen their balance sheet and survive till 31st December 2021. So that's a long time that they can survive, and they've probably raised more than they require. So that 1.2 billion is made up of $1 billion to institutional investors and 200 million for retail investors like us. So the institutional placement has already happened, and the shares there are expected to start trading on the 15th of April. And the share purchase plan, or SPP, is an opportunity for existing shareholders, retail shareholders like us, to subscribe for new ordinary shares. So that's the 200 million for retail investors to participate in this fundraising. Auckland Airport has also suspended all future dividend payments until December 2021. So sorry for dividend investors. Now let's take a look at the details of the SPP. The additional liquidity provided by the placement is expected to provide capacity to meet all operating, investing, and financing cash flow obligations to 31st December 2021. And so they're trying to plan for the worst case scenario, because essentially they're planning for a highly subdued current travel environment continues until 31st December 2021. So that's the reason for them raising money. And to participate in this shareholders purchase plan, you need to be a shareholder before the 3rd of April to be eligible. So if you didn't have shares then and you buy the shares now, you cannot participate, unfortunately. If you did have shares before the 3rd of April and you sold your shares, you'll be fine. And the new shares are priced at the lower of $4.66, or a 2.5% discount to the VWAP of the latest 5 trading days. And that is the 20th to the 24th of April. And the share purchase plan closes on the 24th of April, and new shares trade on the 1st of May. So you might be thinking, is this an arbitrage opportunity? Because the current share price is $5.75. So that's roughly a 23.3% upside on the table. So the arbitrage opportunity is to sell existing shares at $5.75 and buy back through the share purchase plan of $4.66. Well, you have to consider as well whether buying at $4.66 is reasonable value, because there's no point buying a stock for $4.66 if it's only worth $3. Well, my financial modeling has actually showed that this current valuation seems fair using a discount rate of 7% and a terminal growth rate of 2.5%. The current share price is essentially the market pricing in FY20 and FY21 profit to be halved and a full recovery in 2022. And the famous Warren Buffett did say that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So Auckland Airport is not, say, necessarily cheap, but I think it's a fair price for a good company. Now, there are some caveats to this arbitrage opportunity. There's a risk of scaling based on shareholding. So because the current share price is lower than the market price, I'm going to guess that it'll be oversubscribed because people want to buy the cheap shares. So they might scale down your application if there's too many people subscribing to it. So for example, if you had 1,000 shares versus another guy who had 50,000 shares, chances are he'll get more shares than you because he had a bigger shareholding on the record date. So this is not exactly foolproof arbitrage as well, because there's 1 week from the SPP closing to the new shares trading. So in that week, the share price could dramatically tank and you would have lost money when your shares get issued for you to sell on market. So there is a week there. But underwriters will usually keep the share price above the issue price. I say usually because that's what I've seen in the market. And I've sold all my Auckland Airport shares in my private portfolio on market, and I will be participating in the SPP. So that's the reason why I did sell my shares in Auckland Airport. It's not that I don't believe in the company, it's because I can buy back the shares at $4.66, whereas I sold at about $5.50. So I did leave some money on the table. That brings me to my conclusion of this video. Auckland Airport is a resilient fundamental infrastructure gateway asset. It has, taken a hit because of recent events, which is only temporary, but it could definitely be prolonged. This is not a short-term stock to get rich quick, but I like this stock long-term, and due to all the reasons that I've laid out in this video. I'm going to use this SPP as an opportunity to build a cornerstone position in my private portfolio. Okay, I think this stock is a very resilient stock, and over 5, 10, 20 years it should do well. In the short term, in the next 1 or 2 years, I don't know what can happen. It can continue to drop, and if it does, then even better, because I can accumulate more at a lower price. There's always going to be risk when you're buying stocks, and I guess the question then is how much risk has already been priced in. Personally, based on my own research, I think that the market is fairly pricing Auckland Airport. Now, this is not financial advice. Always do your own research before investing. Auckland Airport is a fantastic company, and I'm going to make it one of my core holdings in my private portfolio. So make of that what you will. I hope this video has provided you some insight into the business. If you enjoyed content like this, be sure to like, subscribe, follow me on Instagram as well. And until next time, take care.